Good morning, everyone. This is Marshall Gittler bringing you the morning comment for July 10th. Well, I was wrong about the FOMC minutes. In fact, they presented a more dovish view than people had expected. As a result, Fed funds futures expectations for 2017 fell almost 6 basis points, while bond yields declined modestly. The dollar weakened all around against both G10 and emerging market currencies. The FOMC members agreed to wind down their quantitative easing program of bond buying in October, as was widely expected. There was also a technical discussion of how they'd manage the money markets as they move to liberalize interest rates. Without going into the details, it implies that the actual Fed funds rate is unlikely to rise for at least a year. Moreover, many participants also agreed to delay ending the reinvestment of maturing mortgage-backed securities until after they had started hiking rates, even though that's contrary to what the FOMC said when it announced its exit strategy principles in 2011. Both of these measures are seen as relatively dovish, which is one of the reasons for the move down in interest rates. Another surprise for the markets was just how concerned the FOMC is about inflation remaining too low. That goes a long way towards explaining why Fed Chair Janet Yellen recently dismissed the rise in inflation as noise. Apparently, she wasn't just talking for herself. It's true, though, that there is disagreement among the FOMC members with regards to both inflation and the economic outlook. I expect that as time goes on, this divergence will become more and more acute and more distinct as the two sides make their views public through speeches and interviews. That could help to raise volatility somewhat. The implications for the dollar are that it is not likely to get much support from the FOMC, at least not immediately. With inflation rising and interest rates falling, U.S. real interest rates are declining, which is likely to prevent the dollar from gaining overall. We'll know more after today's speech by Vice Chair Stanley Fischer and Yellen's testimony to Congress next week. In the final analysis, the FOMC is really no better place to know what's happening than the market is. Everything depends on the data. Meanwhile, ECB members aren't showing much concern over the stronger euro. With the FOMC not worried about inflation and the ECB not worried about the higher euro, it looks like euro-dollar is likely to be stuck within its range until something happens to push it out. That something is likely to be an adjustment of Fed policy, eventually, in my view. As for today, the Bank of England's Monetary Policy Committee meets. Once again, they're unlikely to change policy, and the impact on the market, as usual, should be minimal. Last month, sterling rose about 15 pips after the release, but returned its gains within the next few minutes. The minutes of the meeting, however, should make for interesting reading when they're released on the 23rd of July. We have several CPI figures coming out today, including Sweden and Norway. Norway's CPI is forecast to have accelerated. That could support the Norwegian krone, as Norway is one of the few countries in Europe where the central bank isn't confronting below-target inflation. In the U.S., initial jobless claims are expected to have remained unchanged, which won't excite anyone. The feature of the day will be a speech by Fed Vice Chairman Stanley Fischer, as I mentioned. As far as I can tell, this is the first time Fischer has spoken publicly since he joined the Fed last month. He'll be taking questions, so there may be some interesting remarks. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.